mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Locke YouTube channel. I'm James Locke. Today we're going to answer 2 more Ask James questions of the day. First question is from Bert. Bert says, I'm about midway through my career. How can I better manage my 401k assets for the ups and downs of the market? Okay, Bert, managing your 401k assets effectively during the ups and downs of the market, that's crucial, especially, like I said, you're midway through your career and likely still in the kind of accumulation phase. Let's dive deeper into some of the strategies that focus on reducing risk and volatility while aiming for that growth. First, it's important to maintain a diversified portfolio. As you rightly mentioned, diversification is key. This means not only spreading your investments across different stocks, but also across various sectors and geographic regions. Consider allocating some of your funds to large cap companies, others to small cap companies, and even some to international markets. This approach helps mitigate risk because different types of investments may perform differently under varying market conditions. Now, regarding your concern about market timing, it's wise to avoid timing or trying to predict short-term market movements. Even seasoned professionals often struggle with market timing. Instead, focus on a long-term investment strategy that aligns with your financial goals and risk tolerance. Historically, the stock market has shown growth over extended periods, so maintaining a disciplined approach and staying invested for the long haul can be advantageous. Now, as you continue to build your retirement nest egg, consider other strategies that can complement your portfolio's stability. So this may include incorporating bonds and bond funds, which tend to be less volatile than stocks and can provide income while balancing the overall risk of your investment mix. Additionally, periodically review and rebalance your portfolio. Market fluctuations can cause your asset allocation to kind of drift from your original plan. Rebalancing involves selling some assets that have performed well and reinvesting in others that may be underperforming, thereby maintaining your desired asset allocation and risk level. So managing your 401k during these pivotal years requires a balanced approach that considers growth potential while managing risk. By diversifying your investments, kind of avoiding market timing and periodically rebalancing, you can better navigate the volatility of the market and position yourself for a more secure retirement. That's an awesome question. If you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. And with that, we will move on to our second question. Our second question is from Candace. Candace says, I'm in the transition years, but I feel like I'm really behind the 8 ball. And I think I should be more aggressive in my strategy. What do you think? Now, this is a tough one, Candace, and thank you for sharing your situation with us. It's not uncommon to feel like you're behind in the transition years leading up to your retirement. So let's break down your concerns and how to approach them with a focus on reducing risk and volatility while aiming for stable income, because that's what it's all about. First, assessing whether you're truly behind the 8 ball requires a detailed look at your retirement income needs and the potential income your investments can generate. So instead of solely focusing on the total growth of your portfolio, which becomes less critical as retirement approaches, shift your focus to generating consistent income. For instance, if you have $1 million and aim for a 5% return, that could yield $50,000 annually. This income-focused approach helps in planning for your retirement needs without relying solely on market performance. To determine your readiness for retirement, consider consulting with an income specialist who can help calculate projected income streams based on your current savings and future contributions. This assessment will give you a clearer picture of whether adjustments are needed in your investment strategy. Now, if it turns out you are indeed behind in meeting your retirement income goals, you might consider a more aggressive strategy to catch up. This could involve focusing more on total return, which includes both income and capital appreciation. However, be cautious of the risks associated with aggressive investing, especially considering the potential for market downturns. Right? As history has shown, there are periods where markets can be volatile and experience prolonged downturns, such as the early 2000s. The key takeaway here is to balance your desire for growth with the need for stability and income certainty as you approach retirement. Avoid making rash decisions based on short-term market trends. Instead, focus on long-term strategy or a long-term strategy that aligns with your financial goals and risk tolerance. So if you find yourself leaning towards a more aggressive approach, ensure you have a contingency plan in place in case of market volatility affecting your retirement timeline. It's essential to stay flexible and adapt your strategy as needed to maintain financial security in retirement. So I hope this advice helps you navigate your retirement planning. Remember, seeking guidance from a qualified financial advisor, specifically an income specialist, can provide personalized insight tailored to your unique situation. Great questions today. If you would like to send in your question, please do so by emailing them to poollocke@poollocke.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the